If inflation averages 4.5% over the next 5 years, not some apocalyptic scenario, not a currency crisis, just a return to what we were living through in 2023, a retiree spending $50,000 a year today will need $62,300 a year by 2031 to buy the exact same things. That's $12,300 of additional annual spending, demanded by no one, owed to no one, and completely unavoidable. And the thing nobody is saying out loud is that the inflation hitting retirees isn't the blended headline number you see in the news. It's running 2 to 3 points higher than that in the specific categories: healthcare, housing insurance, long-term care that retirees actually spend money on. So the real number isn't 12,300. It's worse. And that's what this video is actually about. Here's the part retirement content almost never addresses. The damage from sustained inflation doesn't arrive as a single dramatic event. It arrives the way a slow gas leak fills a room. You don't smell it at first. Everything looks fine. The balance sheet shows a number with a lot of zeros. And then one day, you run the projection out to age 82 and realize the bucket has been draining the entire time, and you were watching the wrong gauge. I'm going to walk you through what 5 more years of elevated inflation actually does to a retirement plan. Not in percentages and vague warnings, but in specific mechanisms, specific dollars, and specific decisions that separate the people who retire when they want from the people who go back to work at 68 and tell themselves it's because they missed staying busy. By the way, I built a free early retirement calculator because most online calculators are mathematically wrong. They use blended average returns, ignore withdrawal timing, and assume a smooth inflation rate that has never existed in the real world. Mine uses BlackRock and Vanguard methodology to expose the actual weak points in your specific plan. I only ask for your email to send the report because I don't store your financial data. Link is in the description. Now, think of your retirement portfolio as a bucket. The water in it is your purchasing power. Inflation is a hole in the bottom. But here's the part that makes the metaphor actually useful. The hole doesn't drain at a fixed rate. As the water level drops, the pressure falls, and your withdrawals, which you've increased to cover rising costs, now represent a larger percentage of what's left. Compounding works against you exactly as powerfully as it once worked for you. The bucket is manageable with a small hole. 5 more years of 4 to 5% inflation doesn't maintain the hole at its current size. It quietly widens it every quarter while you're watching something else. That bucket is coming back throughout this video because by the end, I want you to see the shape of your specific problem, not a generic warning. In a few minutes, I'm going to show you what happened to people who retired in the wrong year, identical savings, identical strategy, wildly different outcomes, and why the timing of inflation alone determined which group was comfortable and which group was quietly panicking by year 6. But first, let me explain why the one thing most people believe protects them from inflation actually doesn't. Social Security has a cost of living adjustment. Everyone knows this. The Social Security Administration calculates it from something called the Consumer Price Index for urban wage earners and clerical workers. In 2022, that adjustment was 8.7%, the largest in 40 years. People celebrated. The problem is that CPIW measures the spending habits of working age people, food away from home, transportation, work-related expenses. Retirees don't spend like that. Retirees spend disproportionately on healthcare, prescription drugs, housing maintenance, and utilities. The American Institute for Economic Research tracks a separate index called the Everyday Price Index, specifically calibrated to actual retiree spending patterns. In high inflation years, it consistently runs 1 to 2 percentage points above official CPI. Here's the specific number that illustrates the gap. Medicare Part B premiums rose 14.5% in 2022. The COLA adjustment that year was 8.7%. Social Security gave retirees a raise, and Medicare immediately took back more than it gave. Over 5 years, a persistent 2-point gap between official COLA and real retiree inflation compounds to somewhere between 10 and 11% of total purchasing power, silently, while the statement shows adjustments happening right on schedule. You think Social Security's Cost of living adjustment keeps you whole. It keeps you feeling whole. Those are not the same thing. There's a woman, I'll call Deborah. She retired in 2019 at 64. $820,000 in a traditional balanced portfolio. 60% stocks, 40% bonds. She was withdrawing 4% annually, roughly $32,800, supplemented by Social Security of about $18,000 per year. Total income, roughly $50,800. She did everything right by every piece of conventional retirement advice she had ever received. By 2022, her Social Security had risen modestly with COLAs. Her expenses had not risen modestly. Groceries were up approximately 20% over 3 years. Her homeowner's insurance, because she lives in Central Florida, had risen 31% over 2 years. Florida's insurance market was in a structural collapse, driven by reinsurance costs and litigation that didn't register a national CPI at all. Her Medicare supplement plan renewed 11% higher. To maintain her lifestyle, she needed to pull not $32,800, but closer to $39,000 from her portfolio. A 19% increase in withdrawals from a portfolio that, because it held bonds, had simultaneously declined in value. That's the second mechanism. And it's the one that escalates this from an inconvenience into an actual retirement ending scenario. Here's the thing. Most people understand that high inflation means things cost more. That's the obvious layer. The less obvious layer is what happens to your portfolio during inflation, because this is where a manageable problem becomes a structural one. When inflation is elevated and persistent, central banks raise interest rates. When interest rates rise, bond prices fall. The 60-40 portfolio, 60% stocks, 40% bonds, has been the default recommendation of conventional financial planning for 3 decades. The entire logic rests on a single assumption, that stocks and bonds move in opposite directions. So when stocks fall, bonds cushion the blow. That assumption held for most of the 80s, 90s, and 2000s. It broke down definitively in 2022. That year, the Bloomberg US aggregate bond index fell approximately 13%. The S&P 500 fell 18.1%. Both fell simultaneously in the same year. For anyone who was already withdrawing from a balanced portfolio, this was catastrophic, not because the losses were permanent, but because of what selling during a downturn does to the long-term math. By the way, hit subscribe if you like this content. YouTube's algorithm may simply never surface my videos for you again otherwise, and I go deep on exactly this material consistently. This is called sequence of returns risk. And in a sustained inflationary environment, it's not a tail risk, it's the base case. Let me make it concrete. 2 people retire with $1 million each. Both earn an average of 7% annually over 20 years. Both withdraw $40,000 per year. On paper, identical situations. One retires in a year when markets drop 30% in the first 2 years. The other retires in a year when markets are flat or slightly positive in those same first 2 years. The first person runs out of money roughly 4 years earlier, despite identical average returns over the full period. The research on this has been replicated across dozens of studies. The order of your returns matters more than the average of your returns, and you have no control over the order. Inflation amplifies this risk in 2 directions at once. It triggers the early drawdown because rate hikes cause market corrections at precisely the moment you're most vulnerable. And it forces you to withdraw more because your spending needs are rising faster than you planned. You're selling more shares at lower prices earlier in retirement. The hole in the bucket gets wider while you're pouring more water out. The bucket metaphor stops being a metaphor and starts being a spreadsheet. William Bengen, the financial planner who established the 4% rule in 1994, based his analysis on 50 years of market data from 1926 to 1976. The inflation environment embedded in that data averaged roughly 3% annually. In subsequent research, Bengen and others who extended his work concluded that in an environment of persistently higher inflation, the genuinely safe withdrawal rate drops to approximately 3.3% and potentially lower depending on the specific sequence of early year returns. On a portfolio of $1 million, the gap between 4% and 3.3% withdrawals is $7,000 per year. Over a 25-year retirement, That's $175,000 you either spend or don't spend, depending on which number your retirement plan started from. Most planning software still defaults to 4%. Most advisors still recommend 4%. The paper it was derived from was published in a low inflation world that has not existed for the past several years. Now, here's a thing people try as an inflation hedge that I want to address before you go looking for it. Tips. Treasury inflation protected securities. The principal value adjusts with CPI, which sounds exactly like what you want. The problem has two parts. First, in a taxable account, the IRS taxes you on those principal adjustments every year, even though you never receive them as cash. You get a tax bill on theoretical income you cannot spend. This is called phantom income, and it erodes the real yield significantly. Second, in 2022, even tips fell substantially in price because real interest rates, the rates stripped of inflation, rose sharply. Tips protect against inflation embedded in pricing. They don't protect against rising real rates. And in an environment where central banks are actively tightening, real rates rise, tips prices fall, and your inflation hedge loses money. The bucket has a tips-shaped patch over the hole. The patch has its own hole. I want to introduce a subplot here because there's a parallel story running through every inflation discussion that doesn't get nearly enough attention. His name is Marcus, fictional name, real demographic. He's 58, works as a regional operations manager at a mid-sized manufacturing company. He planned to retire at 63. His 401k holds $420,000. His house is paid off. Social Security projections show around $2,100 per month, starting at 67. By every conventional calculation, he was on track. Then two things happened in the same year. His company was acquired by a private equity firm, and the restructuring produced the kind of workforce optimization that always sounds inevitable when someone else is paying for it. Marcus was offered a severance package and quietly encouraged to take early retirement. He wasn't ready. The 5-year window between 58 and 63, if he'd worked through it, would have added approximately $120,000 in additional contributions and employer matching, plus compounding on all of it. That money doesn't just not exist, it never will. Compound growth you never generate on contributions that never happened is one of the most invisible costs in personal finance. The Center for Retirement Research at Boston College has documented this pattern extensively. Over 50% of workers who exit the workforce before their planned retirement date do so involuntarily: a layoff, a health crisis, a family caregiving obligation. The majority of those people were not consulted about the timing. And if Marcus claims Social Security at 62, instead of waiting until 67, the permanent monthly reduction is approximately 30%. The Social Security Administration calculates a reduction of roughly 5 to 9% for each year you claim before your full retirement age. Compounded over the gap, 30% of his lifetime monthly benefit permanently reduced with no mechanism to recover it. Marcus's situation is not unusual. It's documented majority behavior. I'm going to come back to him because his story has a specific resolution that matters to the practical takeaways at the end of this video. The gap in your plan is one thing, but knowing where the gap in your plan lives specifically is another thing entirely. The standard retirement calculator doesn't know Marcus exists. It doesn't model involuntary exit. It assumes you choose your date, work until that date, then flip a switch and live on a smooth percentage of a portfolio that grows at an average annual rate until you die on schedule. That's not retirement planning. That's a projection built on the assumption that nothing goes wrong. Here's the part that rarely makes it into retirement content, and it's the gap that made me actually build something to address it. I wrote a book called The Exit Code, 8 chapters of analysis built on 50 years of actual retirement outcome data, not opinion, not motivational framing, actual research from the same data sets that academic researchers use. 2 things in that book are directly relevant to what we're discussing. The first is the 4% trap chapter, which walks through exactly why the standard withdrawal rule fails under sustained inflation and what the dynamic withdrawal method looks like in practice, how you adjust withdrawals in real time based on portfolio performance, inflation, rather than setting a fixed percentage at retirement and hoping the variables cooperate. The second is what I call the 58% rule, which is built on the Boston College data about involuntary early exits and specifically addresses how much buffer you need against that scenario. So a forced exit at 58 doesn't cascade into a permanently degraded retirement. You can get it through the link in the description for less than dinner out for two. And every year you delay building this framework, the compounding math works against you in exactly the ways I've been describing. Now let me go deeper on the categories of inflation that retirement planning consistently underestimates, because this is where the bucket gets a second hole drilled from a direction most people aren't watching. Healthcare inflation has run approximately 2 full percentage points above headline CPI for the better part of 2 decades. If general inflation averages 4% over the next 5 years, healthcare costs will trend closer to 6%. A couple retiring at 62 today before Medicare eligibility at 65 will spend an estimated $14,000 annually on private health insurance premiums, assuming both are healthy. At 6% annual healthcare inflation, that same premium reaches $18,700 by year 5. That's $4,700 of additional annual costs from one line item alone, compounding at a rate that neither Social Security, COLA, nor portfolio growth is specifically calibrated to match. Long-term care costs are a separate layer on top of this. The Genworth Cost of Care Survey for 2024 put the median annual cost of a private room in a nursing facility at approximately $108,000. At 6% annual inflation, a conservative estimate for this category, that number crosses $144,000 within 5 years. The majority of Americans have zero dedicated funding for long-term care. Not a small allocation. Zero. Because it feels distant, uncertain, and deeply uncomfortable to plan for. The bucket doesn't know you're uncomfortable with the conversation. Homeowners insurance is the third category, and it's inflating in ways that don't show up in national CPI averages because it's geographically concentrated. Between 2022 and 2024, nationwide homeowners insurance premiums rose an average of 21%, driven by climate risk repricing, reinsurance market stress, and construction cost inflation that directly elevated replacement value calculations. In Florida, California, and parts of the Gulf Coast, the increases were far more severe. If you own your home in retirement, and most American retirees do this, is a fixed cost that inflates independently of your income adjustments, with no upper ceiling because the insurance companies are responding to actual actuarial data, not economic policy. None of this appears in a standard Monte Carlo simulation. None of it is modeled by the retirement tool on your brokerage's website. That tool assumed a single blended inflation rate, applied uniformly. It didn't model the specific inflation rates of the specific categories that consume a disproportionate share of retiree spending. It's not lying. It's measuring the wrong thing with impressive-looking precision. You think the problem is that inflation is high. The actual problem is that the inflation running hottest is precisely the inflation that retirees face most acutely. Those two things look similar on the surface and produce completely different outcomes on a spreadsheet. There is one more mechanism I want to address before the case study, because it sits quietly in the background of every high inflation retirement, and nobody talks about it until someone gets surprised by their tax return. Capital gains taxation does not adjust for inflation at all. If you bought an index fund 20 years ago for $60,000 and it's now worth $160,000, but over that 20-year period, inflation has eroded the purchasing power of money such that $60,000 in 2005 had the equivalent purchasing power of roughly $94,000 today. Your real gain is $66,000. The IRS taxes you on $100,000. You are paying capital gains taxes on inflation, on numerical illusion, on the gap between what money used to be worth and what it's worth now, which you had no control over. In a high inflation environment, this gap between nominal and real gains is wider. More of what looks like growth is actually just inflation passing through the number, and you get taxed on all of it. Required minimum distributions compound this further. Starting at age 73, the IRS mandates annual withdrawals from traditional 401k and IRA accounts, calculated from your portfolio balance, whether you need the income or not. In a high inflation environment, your nominal portfolio balance may have grown substantially, even if your real purchasing power barely held even. Higher nominal balance means higher RMD amounts. Higher RMD amounts mean higher taxable income. Higher taxable income in retirement means you may cross into IRMA territory, the income-related monthly adjustment amount, which can add anywhere from $800 to $4,800 annually to your Medicare Part B and Part D premiums, depending on how far over the income thresholds your RMDs push you. Medicare uses your tax return from 2 years prior to calculate the surcharge, which means decisions you make today show up in your healthcare bill in 2 years. It's a delayed trap hidden inside a tax, hidden inside a healthcare cost. Nesting dolls of unpleasant surprises. The structural response to RMD inflation risk is Roth conversion, moving pre-tax retirement funds into after-tax Roth accounts during the lower income years before RMDs kick in. The window for optimal conversion is typically the years between retirement and age 73, when your taxable income is often at its lowest. The math involves calculating how much you can convert each year without pushing yourself into a higher bracket than the one you're trying to avoid when mandatory distributions begin. It also requires watching the IRMAA thresholds, because a Roth conversion that's slightly too large in a given year can push your income above a threshold and cost you the Medicare surcharge for 2 consecutive years due to the look-back provision. The interaction between conversion amounts, tax brackets, and IRMA tiers is the most expensive spreadsheet puzzle in retirement planning. In a high inflation environment, where nominal portfolio values are inflated and RMD amounts therefore elevated, the stakes on getting this calculation right are higher than they were in a 2% inflation world. Now, I want to give you the case study, because this is the part where all these mechanisms stop being abstract and become someone's actual numbers. Meet Sarah, 62 years old, suburban Nashville, Tennessee. $1.2 million in a combination of 401k and IRA accounts, roughly 70% equities and 30% bonds, no pension, Social Security projected at $22,800 annually, starting at 67. She needs $58,000 per year to live the retirement. She plans some travel, occasional help for one of her adult kids, normal house maintenance. Under the 4% rule, she can withdraw $48,000 from the portfolio. Her Social Security covers the remaining $10,000 from age 67 onward. The bridge period, 62 to 67, requires her to pull roughly $36,000 per year from the portfolio before Social Security starts. That's $180,000 in bridge withdrawals over 5 years, which is manageable if markets cooperate and inflation stays tame. Now add 4.5% sustained inflation. By year 5, Sarah needs $71,900 per year to maintain the same lifestyle. Her Social Security with COLAs has risen to approximately $25,600. The gap her portfolio must cover has grown from $36,000 to $46,300 annually. She's now pulling more than 4.5% from a portfolio that, if the early year sequence was unkind, may have already dropped in real value. Here's the moment Sarah's plan actually breaks. It's not dramatic. There's no single event. It's year 4, when the portfolio balance is $980,000 instead of the projected $1.1 million. Because she withdrew more than planned, returns were below average in year 2 due to a rate-driven correction, and inflation kept pulling her annual needs higher. The 4% rule, calculated on the original balance of $1.2 million, gives her $48,000. But she needs $46,000 from the portfolio, which is now 4.7% of $980,000, a small overage. Except it compounds. Every year she pulls slightly too much, the base shrinks slightly faster, and the percentage required to cover the same dollar amount rises slightly more. The mechanical fix is a cash buffer. 18 to 24 months of living expenses held entirely outside the market in a high-yield savings account, a money market fund, or I bonds up to the $10,000 annual purchase limit, not in bonds, which demonstrated positive correlation with stocks in 2022. This buffer means that when the market drops in year 2 or 3 of retirement, Sarah doesn't sell equities at a loss. She lives on the buffer. She replenishes it when the portfolio recovers. The sequence of returns risk doesn't vanish, but the catastrophic version, forced selling at a market bottom to cover grocery bills, becomes structurally impossible. Financial advisors who charge 1% of assets under management are not particularly incentivized to hold 18 months of your spending in a money market fund outside their platform where they can't charge you on it. This is not a conspiracy. It's just an incentive worth knowing about. I find the whole structure more funny than outrageous at this point. An entire industry built to optimize your money in ways that happen to also optimize their revenue, staffed by people who are paying their own mortgages. The conflict isn't hidden. It's just not advertised. There's also this. 1% annual fee on $500,000 over 30 years at 7% gross growth costs you approximately $930,000 in lost compounding. That's not a typo. The portfolio that grew at 7% reached $3.8 million. The one that grew at 6% after fees reached $2.87 million. The difference is $930,000, nearly $1 million paid to someone for advice that, in the majority of documented cases, underperformed the index fund you could have bought yourself. The bucket metaphor had a second part. I held back until now. The fee structure isn't the whole. It's the person standing next to the bucket with a ladle, taking a measured percentage of what's left each quarter, year after year, while you're busy watching the whole. Back to Marcus, because his story ends with something that matters for the practical section. After the involuntary exit, Marcus did the math on the actual scenario, not the one he'd planned for. Early Social Security at 62, permanent 30% reduction in monthly benefits. Portfolio at $420,000 instead of the projected $650,000 to $700,000. Healthcare premiums for 3 years before Medicare. He ran the numbers twice because he didn't believe the first result. What he found was that the damage was real, but not fatal. And the difference came down to one decision made years earlier that he'd almost skipped. He had been doing modest Roth conversions in his late 50s, during years when his income temporarily dipped. Not because he had a specific plan for them, because he'd read something that made him vaguely nervous about RMDs. Those conversions meant a meaningful portion of his retirement balance was already in a Roth account, growing tax-free, not subject to RMDs, and not visible to the IRMAA calculation. It wasn't elegant planning. It was accidental preparation. He got lucky. Most people in his demographic don't. 3 specific things you can do before 2031 gets here. First, stress test your withdrawal rate against 4% and 5% sustained inflation, not the default 2.5% that most calculators use. Go in manually, change the inflation assumption, and watch what your projected balance looks like at 75 and 85. If the plan breaks at 4% inflation, and many standard plans do, it's not a plan. It's a forecast that requires good luck. Second, build the cash buffer now before you need it. 18 to 24 months of living expenses held outside the market specifically. High yield savings, money market, I bonds, not bonds, not the balanced portfolio. The buffer exists so you never face the decision to sell equities at a loss to buy groceries. This is the single mechanical change with the most documented impact on retirement survival rates in volatile environments, and it costs you nothing except slightly lower average returns in exceptional bull markets. Third, map your Roth conversion window. If you are between 55 and 72, and your taxable income is currently lower than you expect it to be when RMDs begin, every year you don't convert is a year you'll pay higher rates later on a larger mandatory distribution from anomaly inflated portfolio. Get a fee-only fiduciary, not commission-based, not percentage of assets, to run the conversion math against your specific IRMA thresholds. Or build it yourself with a framework in the exit code, which was built precisely because this calculation is too important to leave to a generic retirement tool that doesn't model the IRMA interaction. None of this is complicated in concept. All 3 require you to actually execute them rather than feel generally aware that you should probably think about it at some point. The bucket drains whether you're watching it or not, and the hole doesn't ask for your permission before it gets wider. The cold open of this video gave you the number. 4.5% inflation sustained for 5 years, and a $50,000 annual retirement lifestyle costs $62,300 by 2031. The real figure is higher because the inflation hitting retirees, specifically healthcare, insurance, long-term care, runs 2 to 3 points above headline. The sequence of returns risk is higher because inflation and rate hikes now demonstrably move both stocks and bonds in the same direction at the same time. The tax drag is higher because nominal gains inflate, but capital gains tax thresholds don't. And more than half the people in the workforce today will not choose their own retirement date. The bucket metaphor was never meant to scare you. It was meant to give you an accurate picture of the shape of the problem. A bucket with a hole is manageable. The dangerous version is a bucket with a hole that the owner keeps not looking at because looking at it is uncomfortable and the water level seems fine right now. Lazy investing built more fortune than crypto memes. And understanding exactly how inflation eats a retirement plan will do more for your financial outcome than any hot sector rotation, any advisor with a slick pitch, or any algorithm claiming to beat the market in all conditions. The system was built for your participation in other people's financial products. Knowing that is step one. Building around it specifically is the rest of the job.